This is always one of my favorite topics, so welcome. My name is John Vance, president and founder of Vance Wealth. Today, we're going to be doing our 2022 annual market and economic update. I've now been doing these for, this might be my 18th or 19th year. So this is just a great opportunity to share with clients and professionals that we work with in the community and prospective clients, just kind of an update on what happened in 2021 at a high level, but focusing on economic related issues and what we expect in 2022. So where this one tends to be, I think, good, but also kind of data heavy is that because we're getting into economic issues and some of the numbers, there's just a lot to go through. I try to really condense down a lot of the research that we did into some really, hopefully bite-sized amounts of information per slide. But you know me, I'm gonna run through this with pretty healthy cadence and really do my best to share with you our outlook. And while I do kind of joke that we don't have a crystal ball, we do want to share with you our thoughts to help better prepare for expectations for this year. So I'm looking forward to sharing. And as we go in, let me just make sure everything's working technology. Here are our disclosures. Okay, just real quick, I want to do a quick team update. One of the things is that, as a firm, I just wanted to just appreciate, we appreciate and have a lot of just gratitude towards the community and to our clients for the trust that they place in us. And obviously, since we're still dealing with COVID and really this webinar series really took off when COVID started back, now almost 2 years ago, we just wanted to kind of share as we start here a little bit of just reminder of what we do. So we really look at our role here as a wealth management firm to help our clients and families succeed at every step in their financial journey, inspiring them to achieve more, being by their side to help make the difficult decisions, celebrate life's joys, and be a trusted partner every moment in between. So everything we do as a firm really is trying to embody that, and that goes from how we service our clients to the amount of continuing education and work we put in to continue to get better at what we do and to hone our craft and hopefully be really that best firm that that it's out there, really the highest level of standard. We really strive to that, and then obviously as we add team members, we want to add the right team members that can help fulfill those lofty expectations that we put on ourselves, and so that we can deliver really the best experience for our clients. And so I guess the good news as well is our team has grown. We have 13 shown here. We do have a 14th that we added. We just don't have a headshot yet. We added another advisor, Carissa. So this is just a breakdown of the team. We grew last year from 11 to 14. So last year was a good growth year, just the demands of taking care of our clients and the growth that we've experienced, thanks to the trust that you place in us. Team has grown, and we do anticipate we're going to be likely hiring probably 2 people per year as we head out. Additionally, we'll start looking for some summer interns. So if any of you have, usually we want some college-age kids, feel free to submit some of that information to us. But again, really happy. Kind of a crazy year because we had 2 subtractions and 5 additions. So we have 5 new Vance Wealth team members, and I know we haven't been able to see many of you in person, but this is kind of a snapshot. All this information is also on our website as well, if you want to get kind of a snapshot of what our team looks like. But here's the head count right now. And then, through this webinar, which we call our Advanced Perspective webinar, as well as our newsletter, which many of you get in the print format that gets mailed to your home every quarter. We also repost a lot of this information through blogs and through our social media posts. So hopefully this has been a valuable way to stay connected. We do value the communication piece, and there's so much information out there. And I really do enjoy hosting these webinars every month. I do enjoy the research side and the data gathering side, kind of compiling all of these, all this data, and then delivering it in a way that hopefully makes sense and can deliver value. Sometimes we're kind of balancing between the fear of investing and the greed of investing, and really trying to be that voice of reason and that voice of consistency. And so that's really the goal with this. And so our newsletter is all written by us. So hopefully this has also been a nice tool for all of you to be reading, stay in tune with what's happening at Vance Wealth, and obviously in the general economy as well. So as we start to transition, we're going to just jump right in. A lot of numbers on here, so I'm not going to spend time on every item. But the first column on the left-hand side, it does show what the returns are of these different markets. And this is just looking at the indexes, so just the broad basket of stocks. And you can see here, and then the column to the right of it shows the 1-year total return. So what the markets did as of last year, the entire year of 2021. And then in the other two columns show a 5-year annual return and a 10-year annual return. So just take the S&P 500. Last year had another really strong year, up over 28%. 5-year average return is about 18, and on the 10-year average around 16. And so, as we all know, if you're a student of the market, markets historically have been averaging in the 10 to 11% range over a long period of time, almost coming up on 100 years. So the return the S&P's had over the last 1, 5, and 10 has been above norm, which is not that abnormal considering we came out of the Great Recession in 2008, 2009. And then you can see some of the other numbers. The second line down shows how bonds did last year. They lost 1.5%. And we all view bonds as our safe money, right? Things that are more stable. Well, because we're going into a higher inflationary environment, or I should say we're in a higher inflationary environment, plus with interest rates on the rise, we are looking at that is putting some downside pressure on bonds. But that's also why we're a big believer of diversification. These assets that go into portfolios that we build are going to be different. They're going to have different types of return characteristics. And, there is a little bit of, or a lot of yin and yang when it comes to investing in stocks, investing in bonds, investing in real estate, investing in commodities. We want to build these portfolios that really do provide that long-term balance, that long-term diversification. There's a bunch of other sectors on there that you can see. I guess if we're going to focus on another area, you can kind of move down all the way to this, the Russell 2000, which is the third one from the bottom. That's smaller company stocks. Those tend to be higher growth, smaller companies in the US. That index last year averaged 14% compared to the S&P at 28. And then if you look at the 5 and 10 year below the S&P as well. And so that's abnormal for small caps, which is the Russell 2000. If you look back over the last roughly 100 years, going back to 1926, which includes periods like the Great Depression, small caps tend to outperform by about 1.5%. So that's an abnormal 10-year period. But we know those things will come in and out of favor. That's one of the reasons why we're big believers of portfolio diversification, portfolio rebalancing, so that as these things happen in the economy, that we're making adjustments along the way, because it's really hard to predict the future. Now, I'm saying that while we're doing a market and economic update. So this is full of review in the past, but also to look ahead to see what are our expectations, all while having humility around we don't know what the future is going to hold. That's why big proponents of diversification, so that over time it kind of smooths out the results for your portfolios and reduces some of the volatility. So as we start looking at some of this data, so I found two really, we pulled data from everywhere. We really try to go out to all the big investment firms and just all the different sources we can get economic data. This presentation is kind of broken up into two sections. We pulled some data from BlackRock, which I believe they're the largest investment manager. I think they manage like $8 trillion. I mean, it's an absurd amount of assets under management that they have. That number is probably could be off by $1 trillion here or $1 trillion there. But so BlackRock is kind of these first maybe 12, 14 slides that I wanted to share because I thought this was a really good review and a little bit of an insight of what we might expect going into this year. And then the other one is Raymond James based from the chief strategist, and I kind of simplified it down because there's a lot of data in there. So I just wanted to share with you these areas, and just to also, I guess, recognize we're now about 2.5 weeks into the new year. We've had a lot of volatility. We're seeing definitely some correction in some of the growth areas of the markets, which was not, it's not out of the ordinary, probably to be expected. But I just want to acknowledge that we're starting off a little bit tougher way to start, especially coming off of several good years. And so this data shows that we've had 3 strong years. The 2021 year to date, which is that red in the middle, that needs to be updated to about 28%. This was a chart that I found from last month. But what it shows you is that when we've had 3 strong periods of time in the past that where returns have returned over 18% per year for 3 consecutive years, there are 3 instances where we had a 4th year that was also strong. And this is the only other 3 times in our history that that's happened. So not sure if this is going to repeat itself, but this is abnormal to have these kind of returns. But we do have some historical precedent. The most recent one occurred back in the late 90s, 95 to 99, where we had those above 20% returns over those periods of time. So while we're hearing a lot of pundits, the media, everyone's convinced that, hey, things have to go down. Well, not necessarily. Could they? Of course. I mean, that, we're not predicting that. We don't know what this future is going to look like, but it's not out of the ordinary that we might have another strong year. And a lot of that's going to depend on the economy and inflation issues, dealing with the Federal Reserve and how many times they raise rates. So we're going to touch on that, but it's not out of the ordinary to have another strong year. So don't count that out just yet. The one thing that really happened last year, and if we're looking at this data goes back about 20 years, and it shows the number of single day stock market returns of plus or minus 2%. So really just a gauge of volatility. How many actually days did we had where stock market volatility was plus or minus 2%, and this goes back to 2001. So if you look at the very far right-hand side, you can see we had 6 days. So abnormally very, very low. So last year was a smooth sailing year on volatility. Contrast that with the year before where there was 44, and that's positive and negative. So plus minus 2% doesn't always mean negative. You have positive days and negative days, but that obviously was based on COVID, and when COVID hit, the volatility to the downside, and then the subsequent recovery that we saw in the second half of the year. So that just gives you an idea. Volatility really low. I think we might have felt like, hey, this is pretty nice. Portfolios, values every month after month doing pretty well. That's not normal. So I would kind of caution, be prepared for more volatility. It's another big reason why we want to be committed to do these webinars, so we can keep in touch with you in a real-time basis on things that are happening. But you also know, as a firm, we're long-term investors. So while volatility we don't like because it represents potentially negative returns in your accounts, we also know that's just part of investing, right? That's par for the course, is understanding that volatility is here and here to stay. The one thing that gets, I think, people unnerved and unsettled is that we don't know what the source of the volatility is going to be, right? There's always some headline of the day of this is what's driving the volatility. It could be geopolitical risk, it could be inflation, interest rates. So there's always some new headline that kind of freaks people out. But again, the volatility is normal, and we do think it's going to pick up from a quiet year last year. As we look at this slide, so this just shows basically looking at, well, what happens when interest rates are going to go up? So what happened in the fall leading into some of this weakness we're seeing right now, the Federal Reserve basically said, we have high inflation, we have low unemployment, and we're concerned about inflation. We're concerned about inflation and inflation that we haven't seen in many years. And so we're going to start raising interest rates from these basically zero. And so this chart is basically designed to show you, well, how have things done when interest rates go up, right? So you got to remember, interest rates come into two buckets. You have short-term interest rates, which are what the Federal Reserve controls, right? That's the short-term rate that affects cash and short-term loans. Then you have the long-term rates, right? Those are things that are on 30-year mortgages and some of this other long-term lending. So what was fascinating by this data, it really looked at a period for almost the past 30 years and said, okay, well, what about when long interest rates go up? What does the stock market do 12 months later? And then what about when short-term interest rates that are controlled by the Fed go up, and what are the results 12 months later? So you can see on longer-term rates going higher, historically, we've seen stock market returns be really good. And that red on this chart shows that when short-term rates go up, that usually means that stocks are going to deliver a subpar level of return when it comes to a traditional S&P. So it's a little bit of a mixed bag. We don't know exactly what's going to happen. We do know rates are going to go up, and I do have some other slides that we'll kind of go into on this. And so one of the things from a diversification perspective, you should all know this by now, but when you think about the market, right, you just look at the broad market, there are sectors that are more growth dominated, and there are sectors that are more value dominated. And growth has really been the best investment place, primarily because it's driven by technology, communication services, really a lot of the budding technology that we've seen. And so growth really has been a strong place to invest. And so the chart on the left basically shows valuation. So it shows when it uses a ratio called a PE ratio, which is price to earnings. So when you have high PE ratios, that generally means markets are more expensive. When you have low PE ratios, it means that markets are cheaper. So growth stocks typically trade, not always, but typically trade at a premium, meaning at a higher valuation, because your expectations of growth are higher, right? It makes sense. If you have a growth company, you think they're going to grow faster, so you're willing to pay more. So the chart that we have here on the left goes back to basically the dot-com bubble right at the peak on the far left. And it showed you the PE ratio for large growth companies, peaked at 45. Compared that to value companies at 17. And so if we look all the way where we are today, you can see there's a gap as well, and where large growth is trading at a much higher premium around value. And then the reason why the chart on the right is so significant is basically shows when you have a gap on the PE ratio of greater than 15, which is where we are today, greater than 15. Right now, the PE ratio on large growth, at least in the fall, was around 34, and on value was 18. So we have a gap in excess of 15. This basically shows that over a next 3-year period, the average is that value outperforms by 17%. And when you have periods where you have a low gap, is actually growth outperforms value by quite a bit. And so just kind of interesting to share that with you. Now, from a portfolio perspective, our clients are well balanced, well diversified between growth and value. So you shouldn't feel like it's not either or. It's not like I like one over the other. It's really part of the portfolio building and portfolio discipline. What I have been seeing, though, since I've been reviewing prospective new clients, reviewing people's 401ks, we are finding that a lot of people are too overweight on growth. They haven't been rebalancing and having discipline in the portfolio, where they're way underweight value, way overweight growth. So it might be something you look at doing. Again, if you're a Vance Wealth client, just rest assured we have things pretty well balanced, but you want to be mindful of that, because these things can go in and out of favor. And not saying we're at that turning point, but this data, the chart on the right, does suggest that, in a period like now, value does tend to outperform. And what was fascinating as I was going through this has actually been, out of the last 94 years, this has been the 8th best 3-year period in history. Now, what's remarkable about this 8-year period is COVID began, meaning the COVID sell-off, right? When we started to shut down here in America in February, March of 2020. So this best 8-year period, that 2020 period, was right in the middle of this. So this 3-year period was 2019, 2020, and all of 21. So this was the 8th best that we've seen in the history of US stocks. And so that's where we are. That's the reality of what we've been living through over the last 3 years. The next 3 years is kind of a mixed bag. So if you look at the chart on the very far right-hand side, you can see, okay, what do returns actually garner coming out of these really healthy cycles? And it's a mixed bag. We have double-digit returns, we have negative returns. So this was meant to just kind of share with you kind of how remarkable this recovery has been and how strong the performance has been. And obviously we've known that because account values are higher, things have moved forward. So obviously we know past performance is not indicative of future results. Things can change, but it was pretty fascinating just to look back at some of this data from just a point of reference. And then we start looking at, because the reason I put this slide in is you start thinking about, well, what happens when we have our interest rate hike? And what does the markets do after we have our first interest rate hike? So chart on the left basically shows what is the average US stock performance, the average US bond performance, 12 months following the first Fed hike in interest rates. We think that's going to be in the next 6 weeks. Stocks tend to perform, in the past, going back to 1994. So again, this is about a 30-year period, about 7.3%. Not bad, but definitely lower than historical norms. And you can see how bonds perform. So it's not as dire as I think a lot of us think. I'm not as concerned with short-term rising rates. Frankly, I think the economy is ready to handle this. It's kind of time. So I do view this actually as a positive, because you don't want to have the Federal Reserve accommodating the economy too much where things really could overheat, where people really are speculating and making poor investment decisions because of all the cheap, free, and easy money. So it's really important to normalize this and go back. And so I definitely like their approach of raising interest rates a few times. I think they've forecasted 2 to 3 this year. I do think that's healthy. It's going to have an impact on the economy. It's going to have an impact on investing. The exact direction we don't know, but it's definitely a good thing, because we can't accommodate forever. Otherwise, that's how you get these bigger bubbles where things really extend. And so we do view this as a good thing. It's a known thing. Having visibility of what the Fed's going to do is also helpful, but it's not any reason to freak out. And this is a normal part of the Fed policy, is to be making these policy decisions. The other thing that I think gets missed a lot, I do think this is what's driving a little bit of inflation, but it's also why we're still confident that investments can still go higher. And it's just really recognizing the amount of cash that's on the sideline. So the chart on the left shows money market fund assets, right? So these cash balances. And if you look at these important peaks in the market, January of 2003, that peak of cash of $2.3 trillion, that came, if you all remember, at the end of the dot-com bubble when it unwound. And from 2003 moving forward, the stock markets, the real estate market did really well, had a really healthy recovery. And then in January of 2009, that was the next time we saw cash levels peak. That was right following the Great Recession and all the pain that we felt in 2008. And so then obviously you get these cash levels. And why do we get cash levels? Well, when people are nervous about the economy, when they're nervous about the markets, when assets are going down, like the stock market was losing value, the real estate market was losing value, people flood towards cash. So that's why these numbers, that's why these got to elevated levels. If you look back in May 2020, which is this next number at 4.8 trillion, that was because of all what was happening with COVID. People were, all right, we're shutting the economy down, get out of all my investments, go to cash. So cash got elevated. And so when you look at that, and you can see we still are in an elevated cash position. Data is a little bit old, but it hasn't changed too much. And then it really is kind of when, this chart over here shows you, well, what was the 3-year performance following these previous 2 peaks? Really healthy return, 16% per year for 3 years and 19%. And we know it's not going to necessarily repeat the same way. And we can't guarantee moving forward it's going to be the same results, but that's why we're probably more optimistic than most, because the simple fact that cash is what drives my markets higher, right? The reason why investments go up, and I get this question a lot, well, why'd the market go up today? Or usually I get, why did the market go down today? And the simple answer is because markets go down because there are more sellers than buyers, right? When more people are selling than buying, markets go down, investments go down. And all that really is a function is money is coming out of the market, right? If you're selling, you're moving it out. So these high levels of cash balance bode well for performance on a go-forward basis because there's money to be invested. And most money market funds, excuse me, most money market funds are paying less than 0.5%. Well, I haven't done this in about 2 months, so maybe my throat's not ready to start speaking for an hour. So, all right, I think I'm good. Okay, so this is one of my favorites, is kind of this diversification perspective. So I know there's a lot of data on here. And this is a period of time, and this is kind of a hypothetical. This is not an actual result of a diversified portfolio over the last 20 years. It's a hypothetical saying, okay, if I had 25% of my portfolio in US large stocks, 19% in US mid-sized companies, 7% in international, 5% in US small companies, 4% in emerging markets, 25% in US bonds, and like 15% in high yield junk bonds. If I built that portfolio, well, how would I have done over this period of time? And this comes back to this idea of, we know diversification is important, but also it kind of, even though we know it's working, it doesn't really feel good as you're doing it. So let's look at some of these periods of time. So I don't think I have a good pointer today. Let me see if I can, no. So I don't tend to be able to use a good pointer, but I do have a mouse on here. So you can see the year. So from 2000 to 2002, the S&P lost 41%. If you were diversified in that portfolio, you lost 15%. So what's your emotion? What's your emotion? I lost money. Sorry, I'm not sick, just losing my voice here a little bit. From 2003 to 2007, the S&P was up 80%. Diversified portfolio was up 87. Diversification worked. Then we had 2008 hit. Stock market lost 37. A diversified portfolio lost 26. I lost money. So I think you're kind of getting the cadence here. You have years where you lost money. You have years where it didn't make as much. But if you look at the very bottom, the total return over that 20-year period is this whole idea that, you know what, if you look at the ups and downs of a diversified portfolio, diversification can work even when it feels like losing. So it's really important to kind of remember that, is that, you know, this period of time that we've had, especially from 2009 to 2019, markets did really well. Diversification, you just prefer to take more risk. But this is a good reminder that over these long market cycles, that's why we do diversify, even though along the way, it doesn't always feel as good. So inflation effect. So I want to just mainly focus on this kind of right-hand side. You can see historical, where we are from a 10-year government bond perspective, minus inflation. And you can see we're in a negative position. So if you take the 10-year treasury minus inflation, we're at minus 5.4%, which means that's basically the negative yield, the negative interest rate on the 10-year treasury. So what's really hard about that is that if you have a diversified portfolio that has a combination of stocks and bonds, and we know that bond yields are really low, especially relative to inflation, it really does challenge diversification. It really does challenge this idea of a 60-40 type portfolio. It's one of the reasons why as a firm, we spend a lot of our time when we're building a strategy, building a portfolio for clients, is we need to understand their financial goals. We need to understand what their cash flow needs are. We need to understand how Social Security and other investment sources can generate cash flow. Because when we have a really healthy understanding of that, we can set the allocation up to make sure it's more appropriately aligned in areas that can grow, especially relative to inflation. When I started back in 1997, fresh out of college, you could buy CDs paying 6%. I believe the 10-year treasury was close to 8%. So think of the world we live in. It's changed so much. It's one of the reasons why understanding your financial goals really does drive the investment decision, because you need to make sure you're allocating your capital appropriately, where the old 60-40 that would just kind of work through all cycles is very different now because of the low interest rate environment. And right now, I believe that the higher temporary inflationary environment. So this was some of the stuff that came out of the Federal Reserve, and they really broke down this idea of like flexible pricing and like sticky pricing. You know, there are some things that are just sticky that don't move that quickly. There are things like flexible, like food prices, like energy prices that move a lot. They're really trying to evaluate this idea of, okay, well, what's been happening? Why are we seeing inflation? I think everyone's most fearful, and this probably maybe comes back to like the baby boomer generation, right? When they really started entering the workforce was in the 70s. And we had this massive period of inflation, right? You know, you have baby boomers that, you know, bought their first home with mortgages, 14%, 15%, 16%. And so this chart on the left-hand side basically shows this high inflationary period where we had inflation running above 10%, above 15%, right? That's kind of the scariness of that. And then, you know, pretty much for the last 40 years, inflation's been pretty much under control. But because of COVID and a lot of COVID-related issues, supply chain issues, government stimulus checks, issues with the open, number of jobs that are open and the number of unfilled jobs, right? There's all these challenges where we're getting this price hike of inflation. Obviously, there's a lot of cash on the sideline. So we're seeing some of this temporarily. The Federal Reserve projections are that inflation is going to be muted, going to come back down. We have been in an inflationary environment that over the last 10 years, excluding these past 12 months, inflation has been running closer to 2% per year. That's too low. We owe a lot of money as a country. I think our debt is something like $30 trillion. So the Federal Reserve said a few years ago, we want to create a little bit more inflation. Now, when they said a little bit more inflation, they're not thinking 5%, 6%, or 7%. A little bit more inflation to them is 2.5%, 3%, 3.5%. Those are tolerable levels for the Fed, because if you have inflation, that means prices go up. Guess what? When prices go up, that means you have more tax revenue to pay the bills, pay off the debt. And so it's not quite that simple, I know, but that's why one of the Fed does want to have some higher levels of inflation. We think it's going to persist. We're going to have some higher inflation this year, but that it'll start rolling off as we head into 2020, as we get to the end of 2022 and to the into 2023. One of the tricky little secrets of the Federal Reserve too, it's of the CPI methodology, which is, I believe, I can't remember what government entity it is, so I apologize. But one of the tricks that the government how they handle inflation is a little bit deceptive, but also maybe not out of the ordinary. So one of the things that most people don't know is that inflation is based on CPI, so the Consumer Price Index. So they have all these goods that go into that, right? Basically what we consume as Americans. Well, if you look at the changes on the far right-hand side, these are the changes that the government allowed us to make in adjusting inflation numbers. So in 1983, they were allowed to say, we're going to change housing prices to rents. And that is actually the largest individual component. So they are now able to use in the inflation number housing prices or rents. I think whatever they choose. So it's not necessarily always rents. It might be, but I know they swapped out housing prices for rents. Well, that brought some inflation down. 1998, they expanded quality enhancements, right? So we all know that cars are getting more expensive, right? But if you had a car without a seatbelt and an airbag, and now you have a car with a seatbelt and an airbag, they might be mandatory, but they don't consider that inflation, right? If you have a better radio and it costs more, that's a quality enhancement. That is not necessarily inflation because you're getting more for your money, right? So they have been stripping out some of that in the inflation numbers, just saying, hey, if this is a better quality, we're not going to consider that inflationary. So even though it does cost more, that's not inflationary. And then 1999 is where they started getting even a little trickier with this data, is you can expand product substitution. And what product substitution means is that if they have a basket, they do have a basket of food, they can hand pick and say, you know what, we have beef in there currently. However, chicken prices are lower. We can swap chicken out for beef to keep our inflation number, because the argument there is that we as consumers will make those adjustments, right? So they've really worked on kind of massaging these numbers because they, trying to keep inflation under control, because they wanted to do one thing is make sure they're showing accurate inflation, but also the government has skin in the game. They want to see a little bit more inflation, but they also, it's a catch-22 because something like a third of US workers work for US government, or excuse me, not US government, for some government agency. And most of their pay increases, their pension benefits, Social Security, all of those enhancements in terms of how do they make more are based on some level of cost of living. So as we all know, Social Security benefits went up north of 5% this year. And so it's just a little bit of a cat and mouse game, right? Where they want to, the Fed wants to create some inflation to help with the economy, but the government is saying, well, hold on, if we raise inflation too much, then we have to give raises kind of across the board. And so there's a lot of this going on, which is why they've changed this inflation methodology to slow down the growth of inflation. And on the left-hand side, you can see it shows current CPIs. This is what it's grown by over the last 12 months. But if you use some of these other methodology, how high those numbers would have actually been. So just thought I would share that with you. I thought that was fairly interesting. And then it comes down to, okay, well, why are we here? You guys want to know, well, how do how do stocks and bonds typically do when you have elevated inflation, right? So historically, in the middle here is when is an environment where stocks and bonds do well through both of those dynamics. What the markets tend not to like is when you have inflation below zero, which is deflation. You can see on the left-hand side that it means on average stocks have lost 6.5%. That has not happened very often. This goes back over the last 50 years. And on the far right-hand side, investments don't like that scenario either, is where you have above 6% inflation. So the reality is we've been living in the 0 to 2% inflation environment, which has done well for stocks. We think on a go-forward basis, we're going to be living somewhere in the 3 to 4% range. So historically, that still means that's not going to sabotage returns. And so this is going back to the last 50 years. We don't know what the future is going to hold, but just wanted to share a little bit of insight on how things have happened in the past. Okay, so we do have themes for 2022. I'm going to go ahead and take a look I have a couple questions. So I just want to pop in here to see if I can answer these real quick. Okay. So I don't know if I could swing at both these pitches. I got two questions. What is Bitcoin and should we throw funds that we may lose into it? And then the other one is, how is COVID skewing the markets? So I'm probably going to give you a broad answer to this. I think it would potentially derail our conversation and we might run a little bit longer. One of the things that I forgot to start this off with is, when we start looking at time, I do know that this one tends to run a little bit longer. Most of my webinars, I try to keep it around 50 minutes. I know this one's going to probably run at like 70 minutes. So an hour and 10 minutes is my guess. It's the first time doing it. I craft this, from scratch. So just wanted to give you an idea. So I do believe we'll be finished at about 5:40, but I wanted just to give you kind of a heads up on that. So on those questions, like Bitcoin's is a much longer, I don't have time for that, but what I will do, in one of our next webinars, I'm going to discuss a little bit more around like an alternative investment class. So dealing with, how real estate is in portfolios, how we're looking at maybe Bitcoin, other investments. And so I'll focus on some more individual investments just to get into that, because they're digital currency, that's becoming a much hotter topic. So I don't really want to swing at that pitch. And then the last question was really around COVID. How's COVID affecting the markets? I mean, at the individual level, COVID's been massively disruptive to everyone's life, from work disruptions to, unfortunately losing loved ones. I mean, it runs the gamut of how disruptive COVID has been. Because of a lot of the stimulus and a lot of the efforts of a lot of government agencies, it's kind of stemmed pain at the full economy level, especially here in the US. But there's tons of pain that's been experienced through many pockets throughout the US. And so depending on how we're measuring, if you're measuring it as, is my portfolio higher? Is my real estate worth more? Things like that, you could say, hey, this has been pretty good. It's actually stimulating things. And so the one thing that we basically have to recognize is that all the stimulus that's come in from the Federal Reserve, that has pushed up pricing. It has pushed up asset prices. So all of you on this call own assets. And so that has been beneficial. So it's created this artificial money with all the printing of money and all the stimulus that has buoyed prices. And so the challenge the Fed has is, how do I unwind this? How do I move? I'm kind of going back here. How do we unwind all the things that we did and do it in an orderly fashion so we have more of a soft landing so that we just don't come crashing down? And that's the fine line that the Fed's going to have to balance. So we're going to transition into kind of part 2 of this today. So this is really themes for 2022. So Raymond James puts together some really good content on a monthly basis. A lot of the COVID related research that I had the last couple of years came directly from them. So I took their themes, really kind of paraphrased it down to some of the top ones that I want to share with you, and just kind of share some of the insights. I will warn you, there's a lot of heavy content in here. I think it's valuable, insightful, but there's sometimes, guys, I love this analogy, it's like drinking through a fire hose, because there's a lot here. But let me just kind of go into this. And so what we're going to look at here is we're going to have some focus areas. So one of the things we recognize with the economy and what drives the economy is the consumers are primed to spend. So they are ready to spend. And how do we know that? Well, what we're going to look at here is on the far left-hand side, you can see kind of this legend. The legend says these the black like diamonds, or excuse me, the blue diamonds is current, like where are we today? And then it will show this bar chart, and I'll show you an example of this, where it shows the kind of pre-COVID level, the average, and then the pre-COVID low, pre-COVID peak, the average, and the pre-COVID low. So you can see job openings. We have 11 million job openings. We're at a record high. Why does that bode? Why is that good for the consumer? Well, as these consumers go back to work and more, in larger amounts, that's more cash. That's more consumers spending money in the markets. Then we go on to the next one, median household spending plans. So this basically just shows what households are projecting that they're going to spend in this next year. We know there's been a lot of delayed spending because you can't travel, you can't do a bunch of different things. Spending plans have gone up, right? When people are going to spend money, what does that do? That drives the economy going forward. Cash balances, we've already discussed this. Looking at the average consumer cash balance is, 10,000 and above, right? It's pretty crazy when you look at where we are. If we have an elevated cash balance that we haven't seen in any time I can remember. Consumer confidence in the labor market. Most Americans feel really confident that, if they don't like their job, they can leave it. They can just move on. They can truly quit, and they have jobs out there. They're plentiful. They can take time off. And so, there's such high consumer confidence, and that allows people to move jobs, potentially get pay increases, but generally it gives them, a higher quality of life because they feel like they have more control of their work and of their labor situation or their job situation. Wage growth. This one's lacking a little bit. We are seeing some wage growth. We're seeing some improvement there. What's happening though is because wage growth numbers are typically based on real wage growth, and real wage growth is growth minus inflation. And because we've had this elevated inflation spike over the last 12 months, we're not seeing the wage growth numbers that we know people are getting bigger raises. But the reality is, because inflation's running higher, we haven't seen the true real benefit on the wage growth side. Okay, then we look at another thing. Now, look at my headline here. Inflation could be the gift that keeps giving. Well, I kind of talked about why inflation's high and how that's causing prices to go up. Like, how is that a good thing? Well, let's talk about that. So we do think it's going to normalize. So we think these spikes are going to level back down. And I did a whole thing on inflation, about 6 months ago, I believe, and we talked about we thought it was going to be transitory, probably last for 12 to 18 months. That might extend to maybe 24 months, but we do think it's going to be on the way down. And we start looking at, okay, we're in a higher inflationary environment. So what does that mean? Well, when we break that down into having higher inflation, we're getting record earnings growth. Corporate margins are improving because companies can raise prices. One of the big benefits of this is we're getting wage increases. The worker really is taking more control of this because there's so many open jobs that they can demand more for what they're doing. And so that's obviously a good thing. We have seen some wage growth improvements, not to the degree because of the inflationary issues, but it has been better. And we're also seeing, many of us would prefer to not see higher taxes. So because of this higher inflationary environment, what we are seeing that's coming out of Washington is the more moderate Democrats have been concerned with passing some of these real large spending bills, recognizing that, we're talking a few $1 trillion. And actually, by having some of the moderate Democrats that are basically not allowing any bill to pass, that we're basically kind of taking tax increases off the table, at least in a massive scale. Those are all things we were worried about last year. So that's kind of the higher inflationary environment that we saw in 2021. Well, as we get into 2022 and we say, okay, well, now what? Well, if we do in fact have a decelerating inflationary environment, which we believe we will, the data is already starting to see this turnover. It does provide the Fed flexibility in removing accommodation. So they're getting a little what they call hawkish, which means they're concerned about what's happening with inflation. Well, if it starts to moderate, they could probably pull that back a little bit, which is maybe back on track with what they were initially projecting. Consumer confidence will increase, right? I do think the headline risk of inflation is concerning people. So if we get some decelerating inflationary numbers, that helps consumer confidence, which helps consumer spending. And then the third piece is corporate profit margins and earnings remain healthy. So in a decelerating inflationary environment, companies have been able to raise their prices. You're seeing that pretty much across the board. And if that decelerates and inflation is not as big of a deal, then we'll still see really healthy margins, good earnings, and obviously that bodes well for the stock market. So that's why this could be a nice gift. We can't see this persist, but that's not what we're anticipating going on a go-forward basis. So one of the things that does have some economists concern as well is the Fed going to stick to this plan, or are we going to have more rate increases? And so what the markets are predicting right now is we're going to have 2 to 3 rate hikes of 1/4%. So the crazy thing about that is that means that even if they do that, cash balances probably won't even get above 1%, which means you're not going to earn more than 1% in your cash account. So the kind of rate increases they're talking about are still highly muted. They're not big increases. And if you look at where interest rates have been, and this chart goes back to 1970, we've had this decline over the last, essentially since 1980, when interest rates peaked up to around 20%. And then we've seen this decline. So we do think they're going to tick up a little bit, but let's not confuse ourselves. Like, interest rates are crazy low. So by going up 0.75, meaning 0.25, 3 times, that's a change, but that's not dire for our economy. So, don't let the economic headlines scare you. And again, I believe that the Fed's doing this on purpose, and I agree with it. I think they do need to raise rates. It's not healthy for us to sit at 0. And then one of the things is, this is the chart just on the right-hand side, just spends a little bit of time kind of showing us that, that longer term inflation is not really showing up. So this is more short-term based, not longer term. I know I'm moving through this pretty good, but hopefully you're finding this interesting. I do miss the days of being able to see all of you in person, because it's hard to engage in when I'm looking at slides and myself for the full hour, but hopefully you guys are enjoying this. So one of the things as we go, I know it's really early and it's like, okay, John, you're going to talk about politics. Well, I'm not going to spend much time. We probably will do something as we get later in the year. But we probably are on the path for more gridlock. That's likely going to be the outcome of the midterms, given the unpopularity of Biden. And this is not a political statement; it's just what the polls are showing. So this data here on the left basically shows the betting market. So we all know, or we should know, that there's actually a betting market out there that is projecting what's happening in the midterms, what happens in Washington. You can actually bet on it. It shows on the far left-hand side, this was July of last year, all the way up to basically this first week of January of this year. And what it shows is the blue represents the Senate and the green represents the House. And what this shows is the betting market suggesting a red wave, which basically means that the House and the Senate you'll gain more seats from on the Republican side. And you can see the odds have shifted pretty dramatically. And we know that can change. That's just 1 year. So this next year could be different. But this was pretty interesting. This was just through some polling that was done through Raymond James on the survey, was that 4% of respondents believe the Democrats will hold both the House and the Senate. So we know the likelihood that is not going to change. This chart on the right is pretty noisy, but there's a dotted line that's kind of across the bottom where it says current Biden approval rating. So the current Biden approval rating is sub 45% at this time. It might even be a little bit lower, but basically it just shows when you've had certain approval ratings. It shows on the left-hand side of this chart, Obama, then Truman, then Clinton, then Eisenhower. Basically what it shows is the blue represents what was your midterm approval rating, and then what was your seat change. So you can see Obama had a higher rating than Biden going into the midterms and still lost like over 60 seats. That's what that green line shows. It shows negative 60. And then it shows like an example for, Truman goes way back when, but you can get a sense of the fact that when you have approval ratings down this low, there tends to be, it tends to support this data that it looks like we're going to go from majority Democrat to likely just gridlock, which means that maybe nothing gets passed or they got to work together. I haven't really figured out what's going to happen in that dynamic. I don't mind gridlock, but I do like progress. So, but I know everyone's definition of progress is different. But this is kind of the reality. Not likely to get maybe major tax reform. We'll probably see some stimulus, a little bit of an unknown. You know what? I was surprised we didn't get some tax reform going into last year. We spent time on that in a few webinars last year, and you know what? We kind of wasted our efforts because nothing really happened. Okay, so when we look at this, there's a lot of info on this, but it's not that complicated. So I'm not going to walk through the whole thing, but it basically shows, we're going to focus on this left-hand side. Well, so this basically shows is that how does the S&P 500 perform historically under various government compositions? And if you look at the far left-hand side, you can see this is what's currently being projected. As you can see, this blue, the blue represents the essentially the positive range of the markets, meaning how things have done over a 1 year period. It shows the average annual return. So you can see in this example where you have Democrat president, Republican Senate, Republican House, which happens 11% of the time, is a scenario where you've had, if you look across the board, it's the highest annual average return scenario of all of them, right? So now there's higher variation in other years, right? If you look at the very far right-hand side, where you have, or maybe the second from the right, where you have a Republican president and Democrat-controlled Senate and House, that's happened 30% of the time. And look at the range of results, bad market in a much bigger range. So this scenario that's currently projecting by this measure, what we're looking at, and this goes back to 1945, is the best scenario from a purely stock market performance. I'm not talking about how you feel about all the issues that we're dealing with as a nation, but just purely from a stock market, that this is historically the best environment. So I saw this, I thought it'd be a fun thing to share as well. So the other thing too is when we come off 3 really strong years in the markets, on a go-forward basis, it gets harder, right? So this title here is Sledding Gets Tougher for the Equity Markets, right? So it's going to get a little bit harder. And on this first chart shows returns following the first Fed rate hike. So we do think we're going to get the first rate hike here in the next few months. And what it shows is that leading up to the rate hikes, the markets have done well. So if you see on the left-hand side, I know this is really small. So it says -6 months. So 6 months prior, the stock market's averaged about 5%. And then if we look at the very far right-hand side, is 2 years after the rate hike, is that the markets have averaged like 12%. And so it's just kind of fascinating to look through that, is that even though we're looking at, kind of staring a rate hike in the face, it's on the horizon. It's going to add some more volatility in the short term, but on a longer term basis, a 1 year and a 2 year is not necessarily a bad thing. This right-hand side really shows kind of some staggering data. We're looking at 2 periods of time, how the stock market performs on an average year, meaning the volatility throughout a year. And then what it's evaluating is, well, how does it do in midterm years? So we're in a midterm year, which is the green, and it shows that in typical midterm years, we have strength through April and weakness through October and strength to finish the year. Where if you see in typical years, we have strength kind of through the end of the year, and then strength from kind of the November timeframe. So this basically means, kind of supports what we're thinking, is we're gonna have a lot more volatility here over the next 6 to 9 months. That should be expected, but that's also why we manage portfolios. And when we get volatility, we try to do our best to make adjustments to improve the long-term results. So you can see midterms tend to not be a great environment, still positive, but not as high as normal environments. Okay, bull market checklist. I'm going to do kind of a rapid fire through here, but when you start looking at, okay, what are the things that matter to have a healthy bull market? And it's kind of, this idea of transitioning from power to precision, right? When you look at even over the last 10 years, the direction of the markets were higher, probably going to need to be a little bit more precise on a go forward basis, especially as the Fed starts to, rein in some of their spending and interest rate policy. So the economy, we're still seeing above trend economic growth. So still stimulative for our GDP and the economy. Earnings still look to be pretty healthy. It's forecasted we're going to have like 14% year over year earnings growth, which typically bodes well for the markets. Valuations, while they're elevated, they're less expensive than the start of last year because earnings have improved. And so valuations are still healthy, especially compared to interest rates. Corporate activity. So this is a big one. We do anticipate this year seeing a lot of corporate activity, and corporate activity meaning share buybacks, dividends, acquisitions, buying up other companies. We do believe there's going to be some consolidation in the market because there's a ton of cash on the sidelines. And, you think about it, when a company buys another one, that usually means the company that's acquired goes up in value. So we're probably going to see a decent amount of corporate activity this year. And then seasonality. I mean, we did have a really healthy run up in the stock market. We've had a healthy bull market run here, especially coming from the COVID lows. And we do think things are going to be a little bit more muted, but we don't think it's a bear case. We just think it's not even really bull case. It's kind of a little bit more moderate. So I think we'll see some upside, but it should be muted because of some of the headwinds we discussed. One of the things just to share, I generally don't get too much into like dealing with certain parts of the market. I do want to talk a little bit about small companies, so small cap. And when you look at like the small cap dynamic, these are just smaller companies inside the portfolios. When you think about the S&P 500, they have essentially no small cap exposure or small company exposure. So just want to address this. So small cap has underperformed, not last year per se, not small cap value, but over the last 10 years. And so we think there might be a good reason for these to turn, especially because of their cyclical exposure. So basically, this chart shows how much exposure the small cap arena has relative to large cap exposure. If you look at the very bottom, this is the big outlier, is that large company has much heavier exposure to the technology sector. Small companies don't. And we know that because it's dominated by the big players, right? It's dominated by Apple and Microsoft, and Amazon's not even in that category, even though I think we look at it as a tech company. They're considered, a consumer company. So small caps have more cyclical exposure. Those are some of the areas that Raymond James is favoring. So they're kind of forecasting that they'll see some outperformance in those areas. So we know we have tilts to some small caps in the investment. So we're happy about that because we think that'll help performance. The other thing is, if we look at this, just shows that smaller companies are showing stronger earnings per share growth. So EPS is earnings per share growth. And if you look at it on the far right-hand side, it shows kind of what's expected on the S&P versus small cap, is that companies are expected to earn at grow their earnings at a faster pace over the next 3 years. And we know at the end of the day, what drives pricing higher is that when companies have more profits over a long period of time, that's what drives share price higher. Short term, it's a lot of it is, the markets tend to be a little bit more of a voting, a kind of a betting system or a voting system versus being based on the valuations or earnings. And so that's why we do think, just wanted to kind of share with you a little bit that small caps, this is significant, because we do see portfolios have way too heavily weighted in growth and way too heavily weighted in large caps. Good reason to come back and reflect and say, okay, do I have the right growth to value mix? Do I have the right large to small mix? And it's something that we're doing ongoing with our portfolio management team. So it's happening here, but just as something that if you're concerned, especially if you have an outside 401k, happy to take a look at it and make sure you have the right balance. Just some more valuation stuff. Basically this chart on the left-hand side shows small cap valuation relative to large. So when you're seeing the chart kind of dip down, this was in 2001. Small caps really outperformed coming out of the dot-com bubble, and you can see the valuations today show that they're at some of these historic lows. And basically, this just measures PE relative to the S&P. And then the other thing too is small caps tend to outperform when the Fed's tightening, right? The Fed tightening means raising interest rates, and so they tend to do they tend to outperform their large cap after the first rate hike. This just shows the data 9 months out, 12 months out, 24 months out. So there is a case for that. And okay, so a couple quick things as we wrap up. We have a couple more themes to go through here. This is stuff that you've seen from me ongoing, especially the last 2 years. We still have this revolution 4.0 of all the advancements we're seeing in technology. You got to see in my presentation on like the roaring 2020s. So when we start looking at what are the big challenges out there, right? We have communication, labor shortages, climate change, and speed. So these are all things that are being dealt with. So from a communication perspective, right, we're seeing the 5G revolution. We're seeing the virtual reality, right? So that's a communication, the driver. Those are some of the needs that people have. Labor shortages, right? So we're seeing autonomous driving to deal with the truck shortages. We're seeing robots in factories to deal with worker shortages. We're seeing self-checkouts at many stores because of labor shortages, right? So we're finding the technology. That's one of the things that's amazing about innovation, is when we can't get workers to do a job, then we replace that with technology, and that's happening. And that the COVID disruption has really accelerated that. Climate change, obviously the move to solar, to electric vehicles. This far right one, I don't know if you can see it. It's basically, that's a piece of steak on a platform, and it's basically showing 3D printing of steak or cultured basically making of steak. So if you haven't read any articles on how they make steak out of a petri dish or some of the other things, take a look at it. It blows your mind. I don't know if we're ready there conceptually that that's an okay way to consume our beef or our animal product, but there's definitely some interesting technology that's coming out there to, why does that address climate change? Because you don't have the cows polluting, things like that, and all the demands that go into the land, water, resources, et cetera. And then speed. So, we're living in an immediate gratification, same day delivery. That middle picture is 3D printed like house. So you're dealing with like modular homes that can get printed and delivered. And then drones, obviously, for delivery. So we know all these things are happening around us. I didn't even touch on some of the healthcare advances that we've discussed in previous years, but the infotech side, there's the revolution's continuing. COVID is accelerating that. It's not going away anytime soon. So don't want to spend a ton of time on this. This was more of an FYI. So we probably all saw the headlines with China. China markets did terribly. There was a lot of kind of unraveling in the Chinese markets. We have very little exposure to China, but just being an investor, you're going to have some. But it was just kind of interesting that I to see because China is considering emerging markets, but it was pretty remarkable to see the underperformance. I just wanted to share this with you. So this chart shows the green is the S&P, the blue is the China index. And so leading up through, the end of this year, or the end of last year, 2020, markets were kind of moving in tandem. And then you saw this big divergence. So basically, the US market outperformed by 96% over that period of time. What's also remarkable, we all know China also has these big tech giants that are kind of US competitors. You have Google and Baidu, you have Tesla and NIO, you have Apple and Tencent, you have Shopify and Alibaba. And if you look at the US, those US-based companies have done really well, and the Chinese companies have not. So just wanted to share with you, it's kind of more of an FYI. This is not really actionable, although we do expect emerging markets to probably be a better place to be over the next 10 to 15 years. But it's not adjusting really the portfolio dynamics that we're seeing in our accounts. We're still maintaining that broad diversification, but just wanted to share with you on this because I thought it was pretty interesting. And really, one of the reasons why people who are bullish on China is kind of this idea of this contrarian view, right? They had a pretty terrible last year. They might have some bad years ahead of them, but when you actually look at how China is working in what we call old technology, new technology, and evolving technology, this old technology is a little bit hard to read, but back in 2000, the emerging markets only represented 38% of this older technology. They're now up to 64%. When we look at this market around digital payments, so what's happening in the digital payment market, and you can see the growth rates that's occurring in India and China and how low the growth rates are in the US. When we're looking at evolving technology, this is battery cell manufacturing capacity. So you can see what China has. So China has basically, the US and Europe have 20% of China's combined capacity. So China's continue to be a global player. They're still going to be in the marketplace. Again, direct investments, we're getting some of that through some of our funds. But this was more just an FYI. I thought it was interesting just to kind of share with you an update on what has been happening. As we look, I know oil headlines are always kind of painful because when you fill up at the pump and pricing has really shot up. We saw pretty high demand. I don't know if you're aware, energy was the best sector last year. Oil demand is back on track. That's what this left chart is showing us. We are back to essentially, we're on track to hitting these pre-COVID levels. So we're not quite there, but you can see this middle chart shows the blue, shows the dip in global demand and where we're projected to be as we start this year. So we're definitely starting to see us get back to these pre-COVID levels, and the price of oil is showing that, right? We're actually moving in that direction. So we don't expect oil to run away from here. We think at $80 a barrel, $85 a barrel, they're elevated. But the other thing that it does do, especially for those of you who are, and I think we all as Americans are very big proponents of renewables, big proponents of moving to cleaner energy. The one byproduct of having higher energy prices or specifically higher oil prices is it actually gives a boost to renewables, because when pricing goes up on oil, then when people are making choices to say, well, I don't want to spend this much on oil, I'm going to spend this additional money to buy maybe a more expensive car, and I'm going to take the electric vehicle approach. That works really well because then you're actually saving money as a consumer. When oil goes from 80 down to 40 or down to 25, what happens is consumer says, well, hold on, if I switch to EV, it's actually going to cost me a lot more money, right? So these higher oil prices are actually causing this boost for renewables because of that. This chart on the left shows what the renewable energy sources, basically set to increases. This is the, percentage total energy consumption. So right now we're around 12%. The 2030 forecast is projecting 29%. So obviously a massive growth. And we all know that in the demand for electric vehicles and all the components that go into that. And then it shows greater EV adoption kind of by country. So you can see, we're looking at the amount of sales. I think that's like 18 million of sales, where right now, nationally globally, we're at like 6 times sales. So we're looking at, over the next basically 4 to 5 years, things going up, like 4x, which is pretty remarkable. Those are big numbers. So that's obviously a big theme, and that's, a lot of big companies are benefiting from that. Okay, so got a couple more here, and then we'll be wrapped up. Volatility was really low. This shows the number of 5% pullbacks. We were way below average. You can see that little sliver at the bottom here. Is a little green sliver that shows the number of pullbacks. We had very few that were north of 5%. That's abnormally low. Do believe volatility is going to pick up. And last year, this what we call intra-year decline was only 5%. That was the biggest. During COVID, it got down to 34%, which means during the year, the markets lost 34%. Last year, we only had a 5% correction. I think if you look at the markets already year to date, we've already exceeded that 5% correction. So 2021 was remarkably stable. 2022, volatility is going up. I think for time's sakes, I want to finish this up, but here's some of the reasons. Fed tightening, midterm elections, COVID-related impacts, rising interest rates, momentum and complacency. Yeah, you're definitely seeing a lot of speculation went into last year, and you're starting to see some of that unwind, which I like. It presents volatility, but it also presents opportunity. Okay, so I kind of, as we wrap up, what's your focus for 2022? If you haven't read Atomic Habits, it's a great book. It's a great way to start the year. I actually started my year off last year reading this. I had a goal of reading 24. I fell a little short, read 18 books. So if anybody needs any good resources, I read a lot of business and self-help. So if you have any questions, please let me know. But Atomic Habits is a great book. I just had my stepson read this, and there's just a lot of good things in there to just become a better human being, have better daily habits. So definitely encourage it if you did not pick that up last year. So as we wrap up, a couple things here, just want to remind you, I'm sure we have some prospective clients. If you want to have a 30-minute consultation to just see how we might be able to help, you can scan the QR code or go book an appointment online. If you're a client, our annual review seasons tend to run between around February 1st till around the end of May. So we have about a 4-month period where we do annual reviews with all of our clients. So if you're curious to know what your month is, we try to stay pretty consistent. You can reach out to myself or Robin or anybody on our team. Otherwise, we'll be in touch shortly to get those on the books. A couple other things. We have I guess an additional webinar, which we call Healthy You Equals a Wealthy You. We have a business owner in Santa Clarita who also runs a gym and does coaching for business owner or for other gym owners. We're going to be doing a webinar kind of middle of the day, January 27th at 11 a.m. It's open to all of you. Please attend. It's going to be a great conversation. And then our advanced perspective monthly webinar will be held on February 22nd, same time as always. We'll get the content out within probably a couple weeks. If you have any suggestions on topics that you want me to cover, please let me know. Not sure if the Bitcoin alternative assets will be next time, but I will get that in the next couple webinars. So I just wanted to pause there and just thank everyone for attending. It's nice, I guess, seeing the number of participants. I was hoping that we were going to be in person, but unfortunately that might not happen till in the spring or summer when things improve here. But I do want to just let people go if they've kind of run the course on this time. We did run about that hour and 15 minutes. I do have some Q&A. So if you asked a question and you want to stick around, I'm going to go ahead and go through the Q&A. So, but if anyone needs to go, this is probably a good time, and I'm going to jump into some Q&A and see what kind of questions I have here. Okay. So one question is, how do you equate the low unemployment rate but over 10 million job openings? So that's a great question. That's definitely something we've been seeing quite a bit in the journal and just different business publications. So there's a lot of moving pieces. I don't want to just contribute it just to COVID and the dynamics around COVID, but there's a lot of moving pieces. So I'm going to unpack a few of them. So certainly you have COVID and fear of going back to work and contracting COVID and not being healthy, right? So that is driving a fair amount of people who don't want to re-enter the workforce at this time, right? So that's a fact that is happening. Then you have another group, which is becoming somewhat prevalent as well, is they have young kids, and they through a lot of the stimulus, let's say they have young kids, both were working, but now they're struggling to find childcare that's affordable. They're struggling to find, the school dynamics of putting kids back to school, having them go back out of school. So there's been a lot of challenges there where you're having maybe 2 income homes where one is going back to work, the other one is not. So that's driving some of that. You have a lot of baby boomers and a lot of people in their 60s, and this has happened for a fair amount of our clients where they had enough money to retire, but they enjoyed working. And now with this, they just said, you know what, I'm done. And retired. And so that's a big number where you have baby boomers, and a big part of our baby boomer population that just is choosing not to go back to work. Well, and there's more that we can go through, but really the dynamics of that question is a great one, is around why is there this disconnect? It's because we had all these people come out of the workforce somewhat suddenly, and we don't have enough people coming up to replace. We've had, an immigration policy where it hasn't been formulated to really bring in enough people to meet our demands. COVID has disrupted the education system with people going to school, graduating with any job skills. So there's a bunch of reasons why it's not going to be fixed overnight. But that's why we do think wage increases are going to improve, but it's also why companies are automating, right? So there's a lot of companies that are going to automate, try to do things more efficiently. That gap's going to probably close here, but it's not closing as quickly as a lot of businesses would like. And we all know that. If you actually see, if you do a walk around any town, you see help wanted everywhere. And you also have places that are doing shortened hours because they can't staff people. Or if you're a patron of a restaurant, the service is not as good, right? They're just understaffed, right? So, it's been pretty tough. So it's a good question. Hopefully that made a little bit of sense on some of the answers around that. All right, got a couple more questions. So I have a comment, maybe question, but the markets will throw a tantrum if the Fed persists with more than one rate hike. Look at December 2018. That's possible. One of the things that, when the Fed starts raising rate, you're always going to get some reaction, right? People can sell. The one thing that happened in December 18 is that the markets did throw a tantrum. This question is exactly right. They threw a tantrum. However, from that point, December 2018 represented the last 3 years. We just had one of the 8th best markets in our history over the last 94 years. So the 8th best 3-year period. So even though there was a tantrum, that didn't mean that was a time to sell or to abandon the markets. It just meant the market threw a tantrum. And we know that always can happen. But as a firm, we look at that as opportunities. When markets are volatile, that's not a time to get nervous or scared. It's a time to recognize, hey, that happens. When markets get really expensive, we want to take some profits. When markets sell off, we want to take some of the more conservative investments and go in and buy. And that's just the portfolio diversification and the portfolio rebalancing process. And so you're exactly right. The market might throw a tantrum if the Fed raises rates more than one. I think it's going to be a little bit more muted because it's expected. The other thing that the Fed's not doing is they're slowing down their bond purchase. And their bond purchase, I think that's more of not a concern, but that's going to have more impact on pricing because there's going to be less cash out there to fuel these asset prices. Okay, I got lots of good questions today. So hopefully you guys are sticking around. Questions are my favorite part, but I do prefer if I get to see you. But it's kind of hard in this format with these webinars. All right, I got another question. What does inflation stabilizing look like? Does that mean that the prices will remain the same, but spending power will go up? Or does it mean that prices will come down or both? That's a good question. I'll give my kind of my best attempt to answer that. A little bit more complicated, but my expectations are that at the full economy level, right? Every industry is going to be a little different. We've already seen lumber prices plummet, right? So lumber prices went crazy and came way down. So when you're talking about each individual thing, like our oil price is probably going to come down, probably. Our home price is going to come down. I don't think so. I think we'll probably maybe stabilize and we might not see as much appreciation. But when we're looking at the whole economy and how they measure inflation, my best sense of this is that we've seen this readjust of inflation going up 6-7%. And from here going forward, the subsequent increases in inflation are going to be tougher because we've already moved up that initial amount. So what I think is going to happen is we're still going to see inflation, but it's going to settle back into a 2, 3, 4% for the next year. And then in 2 years, maybe more like 2 to 3%. But the reality is the inflation that already occurred across the economy is there. So that means if you don't get a raise, your real wages have come down. So it's kind of a combination of both. Prices are probably going to continue to go up, but spending power is probably going to remain the same or might go down depending on the wage dynamic. But hopefully that answered your question. That's a good question. It's complicated to kind of unpack all those areas, but that's what we're anticipating is that this one-time jump in inflation, or this maybe we'll look at it as an 18-month jump in inflation, has happened, and we're not going to revert back from that. It's just going to start normalizing and leveling off. All right, so let's see here. Got another one. I got a question that says, why did millions of people drop out of the workforce and therefore came off the unemployment rolls? My data is a little fuzzy, or I guess remembering some of the dynamics of that, but I believe if you drop out of the workforce and you're looking for a job, collecting unemployment, and actively pursuing a job, you will show up as unemployed. Once you stop, then you go away. So that's why the unemployment rate's been coming down. The data that I look at is something called labor participation, or sorry, workforce participation, and that measures the percentage of our population that is actually participating in the workforce, and that number has come down. So unemployment rates are artificially low because a bunch of people just dropped off, and that's why they're not showing up. And I don't know the technicality if it's 6 months or 9 months or how that works, but that's essentially why it works that way. Is you have people who get laid off, decide to retire, they're no longer considered part of the unemployed. They're clearly not working. They're not in the labor workforce numbers, but they stop getting counted as part of the unemployment number or percentage. All right, I just got to thank you, John, for your action-packed content. I always learn tons and enjoy your presentation. Well, thank you. Okay, I got another question. Rising interest rates typically affect real estate negatively. So, all right, there's some truth and some, I guess that's maybe a myth, but also there's some truth. So what's interesting about interest rates, especially when it impacts real estate, clearly when you have really low interest rates, that helps real estate prices stay elevated, because borrowing $1 million or $2 million or whatever it might be to borrow that kind of money puts you in a position where your expenses are really low on that, right? If you have a 3% 30-year mortgage on $1 million versus 1.1 million, it's not a huge monthly amount to go up another 100,000. So low interest rates definitely allow for higher real estate prices. But where I would say that statement is maybe a myth, this idea of rising interest rates typically affect real estate negatively, what I would argue is that in a rising rate environment, that actually bodes well for real estate in the short term, because what happens is anybody who's on the sideline, who's waiting, who says, I don't know if I want to buy, or I don't really like that house, let's keep looking. When the threat of rising rates occurs, what happens is people are forced off the sidelines because they think to themselves, well, if we buy now, while maybe it's not the perfect house, I get a 3% interest rate. If I wait and we purchase in a year, maybe we're at 3.75. So now the cost of owning that home goes way up, assuming prices stayed the same. So actually what tends to happen is when you start getting some rising in interest rates, it actually changes the psychology on purchasing, and people are motivated to go make a decision because they don't want to pay higher interest rates later. So, but that's more short-lived than long-term. Clearly, low interest rates has really contributed to higher home prices, but the impact of the threat of rising rates will likely drive the real estate market in a positive way for this year. All right, sorry, I'm just clearing some of these things off. Have 3 rate increases historically correlated with bear markets? I don't know if I have it's a good question. I don't know if I have the data on that. I don't believe so. I don't have this data to support this in this conversation, but typically when you're getting rate increases that have a much bigger move, it's not 3 rate increases, right, of 1/4%. It's not big, not that big of a deal. Usually it's a much bigger move. Like the Federal Reserve, I believe from trying to think of my time frame, but rates that go from like 0% to 4% or 1 to 5, those are much bigger, more pronounced moves. 3 rate increases, 0.75% on a move, in my experience, has not correlated with the bear market. I guess it is talking about a bear market in what? It's not going to be great for bonds, but historically that has not meant a bear market for stocks. 3 rate increases will not likely be enough, but it depends what it's paired with, right? So, but that has historically not been the case. We'll make a note. We're seeing who's asking these questions, so I'll see if I can get you a chart on this, at least with some data to support that. Okay, so we got a couple more questions. Kind of asked the question, how does this affect the stock market if real estate goes down? I mean, generally, when asset prices go down, whether it's in real estate and stocks, that affects consumer confidence in a negative way. So when asset prices lose value because people feel less wealthy, so it's not great for the economy. Real estate has a greater impact, right? Because not everyone's in the stock market, but a lot of people own real estate. And so if we do see real estate drop, that will have a negative impact on the economy. Because what happens is when real estate prices are in a decline, new home construction starts to curb and slow. And obviously we know that new home construction is a big part of job creation and consumption of commodities and goods. So it's not necessarily just the real estate going down is the problem for the stock market. It's the combination of how that impacts the job market, because construction starts to slow when real estate prices go down or soften. Don't know if there's a pure one-to-one correlation on that. All right, got 2 more questions and maybe some more coming in, but so what impact on the economy do you predict will take place considering there is a potential risk of a spike in evictions and foreclosures? This is a tough one. I've had some of these conversations just with investors and real estate people. The evictions piece is obviously real and has a much bigger like human capital component. And I don't even know if I can speak intelligently on what will happen in the case of evictions on the overall economy. Because one of the things that I do recognize is that most Americans, it might not feel this way because of COVID, but most Americans have more of a home than they need, right? They got plenty of space. Now during COVID, we felt like our house wasn't big enough because we needed an office and a gym and all kinds of space, right? But the evictions, I think, will have a temporary, obviously has massive implications on the family getting evicted. I also think it'll cause 2 things. It'll cause people to move to probably lower cost areas, but you also have kind of family picking up the slack, and maybe that's naive of me to think that, but the evictions are harder for me to unpack exactly what happens. I don't really have any economic data around that. Foreclosures is an interesting one, right? So we know some people stopped making some payments when COVID first started, and they got some relief. But the one thing that I don't see a lot of foreclosures coming because people's homes are worth a lot more, right? So even if you're struggling on the cash flow, you have the ability to sell. And from what I've seen is that when homes get on the market, they sell quickly. They sell rapidly. So I don't know if foreclosures is a concern now. Obviously, down the road, if home prices continue to elevate, people keep borrowing more money, keep taking home equity lines, and foreclosures occur, that's never good for the economy. I don't think that's what's going to happen now, because I think home prices are going to stay elevated. Because just think about a replacement cost. If anybody on this is actually tried to get a contractor to go to do work at your house, what my house is actually, what it appraised for, including the land, if I tore it down and rebuilt it, I couldn't rebuild it for what it's appraised for. It would cost me far more money. So that's why I'm not as concerned about the foreclosure side, because the replacement cost to actually build new homes, especially here in Southern California, is exceeding current home prices. So I think the foreclosure issue is less of an issue. Currently, I mean, there might be some per family pain that people have to deal with, but I don't see foreclosures coming on a more massive scale. Okay, let's see here. I got 2 more questions. So, well, but they keep coming in. So, and I'm happy to continue. So, should we be giving our employees 7% cost of living raises to keep up with inflation rather than the customary 3%? So I guess that depends on where those employees are. Generally, I don't want to just give cost of living adjustments for employees. I think I have employees listening, so they're going to hear it directly from my mouth. But generally, I don't give a cost of living adjustments just because of inflation, right? The reason why people get cost of living adjustments is they're doing their job better. They've learned a different skill. They're just, there's an improvement. They're adding more productivity to a business, so you can afford to pay them. Now, I'm also not naive. You have to give them some cost of living to keep pace with some inflation, but I don't think it's a mandatory that just because inflation ran higher, you have to give these statutory cost of living adjustments. I think generally I'm going to give higher cost of living adjustments, but it's got to be earned based on getting better at your job, being more productive, being more efficient, being just, so I don't like the answer of just like, hey, it went up 7%, I'm going to give you 7% a raise. I don't think that's a great way of looking at it, but it's not a bad place to start. But the conversation should be on, hey, if you're going to get a pay increase, and we have these plans for all of our employees, is if you want to earn more, that comes down to getting better. And that's really where we focus. And so it's worthy of a conversation, but I wouldn't drive that. And if that's been a habit that you've been accustomed to, you might want to start unraveling that habit, because if inflation runs higher than even I think, and we have it higher for 2-3 more years, if you give 7% now and inflation runs again at 5, you're going to give 5 again. And then the flip side of that is, if you're doing this, are you raising prices? That's what I know. I don't know how many business owners we had on this call, but that's the reality. A lot of business owners have to look and say, if I'm going to be paying more for compliance and cost for rent and cost for gas and cars and employees and all these things, have I really looked and said, okay, what do my price increases need to be to my end customer to make sure I can afford to run a business? And so certainly the employee cost factors into that. So great question. Last one, at least if I see any more come in, but is Bitcoin considered cash in the market or investment? Oh, that kind of comes back to this whole idea of Bitcoin is a 30-minute conversation in and of itself, or at least cryptocurrency is. I don't think Bitcoin can be considered cash because of the volatility. When I view cash, I view something that's stable. Now, when I see stable, I also recognize that the price is stable, but I know over time it's going to lose money because of inflation, right? We know cash is eroded by inflation. You have cash in a safe, it's not worth as much. You have cash in a bank account, they're not paying anything, it's not worth as much. So I don't know if you can put Bitcoin in there as cash because of the volatility. I think Bitcoin has corrected 50% a few times in its history. That's not a very stable investment. But I also see people using Bitcoin similar to they're going to use, they're using Bitcoin in place of cash because they're tired of not getting any return on cash. So I don't think it's a replacement, but I've listened to a lot of podcasts on whether an appropriate investment in Bitcoin or other cryptos. And I think people can start considering maybe 1%, maybe 2%. Again, that's not a recommendation, but that's what I've been seeing from other people, is that's kind of a target. So I definitely think it's more of an investment. I do think that it's a hard investment though, because I think people still aren't sure, well, how is it valued? Why is it worth what it's worth? And that's going to be something that gets tricky to say, okay, how much should I have in my portfolio? But that's why I'm going to do a longer conversation about dealing with some of these alternatives. So I do view Bitcoin as maybe an alternative to keeping so much in cash, but it's not the same as cash because it doesn't have the stability of it. But at least in the history of it, it has offered some inflation protection, which is obviously good for a well-diversified portfolio. So, all right, we're wrapped up. Thanks for all the great questions. I really enjoyed it. It's my favorite part. Maybe I need to solicit or elicit more questions as we go. So thank you all. Have a great night. Happy New Year, and hopefully see you all soon.